ऑस्ट्रेलिया में अभी हर कोई बजट और उसकी टैक्स इम्प्लीकेशंस की बात कर रहा है, बट कोई असली नंबर नहीं दिखा रहा है. लेट मी शो यू how much does it affect your taxes in actual numbers. So मैंने दो scenarios compare किए हैं where you buy a property in 2017 and you sell in 2027 after holding it for 10 years before the new tax implications come in. And अगर आप 2027 में property खरीदते हैं and you sell it in 2037 again holding for 10 years, both the purchase price are $500,000 and selling it for $1 million. So here's a head-on-head comparison of the old rules versus the new rules, that is the CGT versus indexation. So if you bought a property in 2017 and you sold in 2027, you hold it for 10 years. And this example shows if you buy a property in 2027 and you sell it in 2037. So again, holding for 10 years. So both has a purchase price of $500,000. In both cases, you bought it for $500,000. The sale price is $1 million. So your property doubled in 10 years. Now your gross gain in both cases is $500,000. Okay, pretty straightforward. Indexed cost base. This is the new method of calculating the tax you would pay on capital gains. So what this does is basically it changes the cost base from $500,000 and adds then CPI percentage increase every year to this. So for this example, I've taken a 3% increase in inflation every year and I've added that to the cost base, which gives us $671,000. You don't have to know a lot about this. Basically, there's a tool that would help you calculate this. So for this example, just index cost base is 671, 50% CGT discount. So if you sold a property in 2027, you get 250 discount, which is 50% discount on the gain. It's pretty straightforward to calculate. In this case, there is no CGT discount here. Taxable gain. So this is the actual gain that you will declare in your tax return. So as per the old rule, you made a gain of $250,000 and this is what you pay tax on. As per the new rules, you gained $328,000. Here is the main difference and you will pay tax on this. Let's say you're earning a salary of $100,000. So total taxable income in your tax return for the year when you sold the property will be $350,000 here, $428,000 here. Now here's the magical number. The actual tax on the gain of the property is $107,000 in this case, and $144,000 from as per the new rules. So your net gain in the property after you sold is $392 and $355K here. So basically, you are paying $36,680 more tax as per the new rules on a $500,000 gain based on a 3% CPI increase. Obviously, this will be more or less because the inflation won't be 3% every year. But this just gives you an idea of how much does it actually impact the dollar value. Comment whether this will stop you from buying an investment property. And remember, this only applies to existing houses. So new build do not have these implications.